everyone, and welcome to this year's mid-year update. I'm Ron Insana. 2016 has been anything but a typical year for the markets and the global economy. A number of events triggered tremendous uncertainty in the first half, including the historic vote in the United Kingdom to leave the European Union. Now, we also saw energy prices plummet and rebound, renewed concerns over a possible recession in Europe, jitters over China's slowing economy, and in the U.S., one of the most polarizing presidential races, to say the least, in decades. So what could the second half of the year bring, and how can investors think about the risks and opportunities that are out there? Here with me to discuss this are three of our top strategists from Bank of America Global Wealth and Investment Management: Chris Hyzy, Chief Investment Officer; Marianne Bartels, Head of Portfolio Strategy; and Joe Quinlan, Head of Market and Thematic Strategy. Welcome to you all. And then, Chris, I will start with you. 2016 had, at least at the beginning of the year, remarkable amounts of volatility. Not unprecedented, but still scary enough. So given that people are understandably uncertain and concerned, how do you view the environment now?
You know, we call it a buffalo market. It's one that tends to roam, quite often for long periods of time. And then when there's a somewhat shock or something a little bit negative out of the ordinary, it tends to run the other way. And that's what we saw earlier in the year. We saw it again after the Brexit vote, only to retrace those losses. And now, sitting at all-time highs. And the mood for the second half, the political uncertainty is still at its highest level it's been, not just here in the United States, but outside the United States. There's silver linings to a lot of things going on, but the focus right now is squarely on earnings momentum, not for just what we're about to see for the upcoming weeks here, but for the back half of the year.
So, Marianne, with respect to the new highs that we've seen recently in the stock market, is this a breakout or a fake-out breakout?
Well, here's the thing. If the trend does continue, we expect it to have a little bit of a shelf life, but we're also looking for episodic volatility to potentially continue throughout the rest of the year. The question is, are there still opportunities within the market, no matter what the market does? And we say yes. And what we're really focused on within the equity market are large cap, high quality companies that pay a dividend and have the ability to increase dividends. When you're looking at the fixed income market, we think that part of the investment grade market and, of course, part of the municipal market will do well. But again, we're focused on quality.
Now, Joe, this episodic volatility has not just been in the stock markets. We've seen it in commodities. We've seen it in foreign exchange currencies, the British pound having its largest single-day decline ever. What about those other areas, those other markets? Should we expect volatility, but also do you view any opportunity sets within them?
Ron, keep your eye on the global economy, the global output. We're still growing at, say, 3.25%. China's growth rate's been cut in half, so it's 6%. The EU's expanding like 1.5%. So I would kind of keep my eye on the fact that the global pie is increasing and be opportunistic, whether it's the developed markets, whether it's the China internet side of the equation. So there's opportunities out there. There's just the negativity gets the headlines, but underneath the surface, there is an upward movement in output.
Now, Joe, how about China, which is something you've been focused on with respect to slowing growth concerns, although it seems more stable now than it was earlier on?
Because I think, Ron, because the markets are coming around to recognizing it's 6% growth. It's probably not 7%. And China is throwing the kitchen sink at their problems, fiscal and monetary policy. But, this is a country with a huge savings rate. They've got the wherewithal to kind of collar the problems and move forward. And people are underestimating the consumer is taking on more of the burden of growth. So, China's in a transition. They can build a dam in 2 weeks, it seems like, but it takes years to kind of restructure and move the economy forward. But also remember, China wants a strong currency. So I don't see China being a catalyst to a race to the bottom when it comes to currency.
Let's talk a little bit, Marianne, though, about the currency with respect to how it impacts international markets. So the U.S. and Europe have actually looked remarkably solid despite Brexit and other concerns. Emerging markets have been hit or miss, really, in a lot of ways. I mean, what about the emerging market arena?
So we've become more constructive on the emerging markets. And as you point out, emerging markets are just not one country. There's multiple countries. And we do favor China and part of their reforms. And we favor countries like India. One that we don't talk about very much, which is very close to our border, is Mexico, and trades very similar and is near records. So what we've seen in emerging markets is all the bad news pretty much priced into them. So the valuations look very attractive, but there's still some risks. But for our investors that can diversify, add a little bit of risk, and hold these assets for a long period of time, we think will be rewarded.
Chris, let me ask you about oil. From the February bottom, oil more than doubled, or just about doubled. Has oil exhausted its run?
Productivity in general, technology in general is likely to keep a lid on oil prices for as far as we can see. Equilibrium for oil prices in general is around mid-50s, which feeds into a really good gas price, which feeds into better consumer spending, or at least keeping consumer spending the momentum going. And all things considered, that's a good price for GDP growth.
And Marianne, the consumer, and we've seen this in consumer stocks, has been relatively buoyant. Consumer spending has been reasonable throughout this whole period in the U.S., no?
Yeah, that's the whole story that we have here in the United States is the consumer is still spending selectively, but still spending. And if we do hold a breakout in the markets, the wealth effect will be there. And Joe, you can talk about the consumer in emerging markets. There's huge consumer stories that are occurring in the emerging markets.
Irregardless of what's happening in Brazil or Russia, I mean, those consumers are still, they're traveling, they're buying cars, they're still looking at real estate. So that's a long-term trend that's going to play out. One thing I said about consumer spending here in the United States, remember, amongst college-educated workers with a 4-year degree or more, that's considered skilled labor, the unemployment rate's 2.5%. Right. It's basically full employment, and they disproportionately drive spending. So the consumer's in better shape than even the numbers suggest. We've got over 5 million job openings in this country, but we've got a mismatch with the graduates and the skill set. And I think that's slowly but surely being reconciled.
I think a good portion of the consumer spending that's going on in our environment today, our social network environment, our digital device environment, is not being picked up in how we used to measure old line retail sales. Right. So a good portion of what we're seeing in the shift out of the big box, and the whole effect over the internet, that's one thing. But the second thing is the consumer shift going from what used to be largely goods purchases to experiences now.
In this presidential year, it does seem that there is some trepidation, not only among consumers, but among investors about how November is going to turn out. How much uncertainty premium is, given that we're at record highs, if at all, is built into the market right now, Chris?
There's clearly a discount on valuations, even though valuations may be rich in some measurements. So one has to ask the question, how much is that in relationship to political uncertainty? I think a good portion of it is. But when you build pockets of the economy, there's some very high growth areas, and the market's now starting to transition towards that. But overall political uncertainty, particularly this election campaign, which has many, many different elements to it, that mixes with what's going on in Europe.
Let me stay here, though, Marianne. Is it more important from an investment perspective to determine whether or not the White House, the Senate, and the House all go in one particular direction?
Well, I think you have to know what you wind up with. And there's a lot of uncertainties right now. And even when we get a new president, they have to build out their whole cabinet. And there's a process there. So what we're telling investors is you can't really invest based on what might happen, but invest on what we know. What we know, which doesn't get enough press, is that there was a fiscal bill that was signed in December, and it was $80 billion. Half of that $80 billion went to defense. So the aerospace and defense industry is performing very well. Yeah. The other 40 were kind of split between tax extensions and infrastructure, and we're seeing infrastructure stocks do very well. So we'd rather focus on the knowns than start anticipating what might happen. But let me tell you, Ron, the market can't be that nervous if we're breaking out and if we hold all-time new highs.
All right, so given everything we've talked about thus far today, for investors, what two actions, and Joe, I'll start with you going around the horn, would you suggest that they focus on between now and the end of the year?
Well, think long-term, Ron, in the sense that we still got global growth. We've got an emerging market middle class that's still buying things and doing travel, experiences, everything we talked about. So to me, look at the global brand leaders, principally the United States. And then number two, Brexit is an inflection point for more fiscal reflation. So there's a lot of negative headlines in and around Brexit. It's still ongoing. But I think that when we look back 2-3 years, that'll be a trigger point to get off the monetary policy and more fiscal reflation. I think the markets are going to sniff that out, and it drives the equity prices higher here and overseas.
So Marianne, how about you?
We actually have some internal indicators that are actually giving us some very positive signals for not only our economy, but global economies, and that can actually signal that possibly going into the end of the year, there's investment opportunities within the marketplace. So again, we want clients to stay focused on their long-term goals, maybe talk to an advisor, look at their portfolio, see if they need to do any type of rebalancing. But it's really about getting to your goals and really not paying attention to all of these violent movements within the market, or just use some of these movements as opportunities to position.
And Chris, you get the final word.
With as low as interest rates are, the search for yields should continue. It's a lot earlier in the phase than what most people give it credit for. And the consumer has a much better balance sheet than people give it credit for. And the consumer spending side of the equation is what's going to continue to power the engine of growth in the United States. And it may not all be as high as we want it to be, but it still continues to move forward and present enough opportunities out there for continued investment.
And let me thank Chris Hyzy, Marianne Bartels, and Joe Quinlan. Thank you very much for the discussion.